Well, thank you so much for joining this session. It's called the Achieve Financial Independence Controlled Burn, and I will be leading this session. My name is Roshni Pandey. I'm a financial advisor for TrueRoot Financial. So when it comes to achieving financial independence, why is financial independence important? It's important so you can live your life on your own terms, right? And what does that mean? It means you have freedom of choice on how you want to spend your life. And what you want to do with that freedom is really personal. Everybody has a different version of what you want to do with your financial freedom. So the first thing that we'll do before I start the session is for you to write your own statement of financial purpose, okay? So please take your pen and paper that was on your seat, and I'll give a minute for you to write your statement of financial purpose, which is basically this sentence: I want to achieve financial independence so that I can fill in the blanks, whatever it is for you. Like some of you are done. So if somebody wants to tell me their statement of financial purpose, read it out. Anyone? Go ahead.
I want to achieve financial independence so that I am never reliant on someone else for my livelihood.
Yes. Great. Yeah. Did you want to read out yours? No?
I wrote so that I can choose to do what I want with my own time and weather storms with all available resources.
Yes. So this is the first step that I take whenever I'm working with the client on their financial plan and investing journey, to figure out what is their statement of financial purpose. This is your big why. And the reason why we want to know your big why is because when it comes to money and investing, there are always trade-offs. Right? There is always risk and reward. You take a lot of risk to get a certain reward, but a lot of risk can also lead to financial losses. There are always tough decisions you have to take. And so your big why, your statement of financial purpose, is your North Star. It helps you make key decisions when it gets tough. So whenever I ask clients this question, these are the three common responses I get. Number one, I want to have financial independence so that I can have greater quality of life, be ready for life milestones, take nice vacations, pursue passions, which basically is similar to what some of you guys said, which is you want to have more freedom of how you want to spend your time. Second is career flexibility, to achieve early retirement, a sabbatical, to spend more time with friends and family, or to pursue philanthropy, or to start my own business. Third is have less stress, more peace of mind, which one of you said as well, and not be reliant on anybody else for your life, basically. And who doesn't want that, right? Who doesn't want peace of mind? So those are the three biggest reasons. So I will start this session by talking about the first key reason that we want to achieve financial independence, which is to have a great quality of life and be able to achieve all the life milestones while also being able to live the life you want, which might mean taking nice vacations, pursuing passions, etc. Now, to be able to do that, you have to be very clear on your finances. You have to know where you stand. How much money are you making? How much money are you spending? Are you saving enough? Are you going to be able to hit those goals, those financial goals you have for yourself? And the way you know that is by doing two things. First is by doing a balance sheet, and the second is by doing a statement of cash flows. A balance sheet is a snapshot in time of where you are in terms of your finances. A balance sheet includes your assets, liabilities, and assets minus liabilities gives you your net worth, right? This is how much you're worth today. And since this is a snapshot in time of where you are, this will keep changing as we go into the future. And the goal here is that this number, this net worth, should increase over time. If it's not increasing, we need to figure out why it's not increasing and take steps to do that, okay? So that's the first thing that we need to get clear on your finances. The second is a statement of cash flows. A statement of cash flows basically shows everything that's coming in and going out of your bank account, your entire financial life, from now until the end of your life. Okay? So this is a sample cash flow. This is for a couple, 44 and 42 years old. And this goes from today, from 2024, all the way to the point the couple is 90 years old, right? Which is the projected lifespan for somebody at this point. We want to make sure that you're financially okay from now until the end of life. And there are a few things that that your cash flow needs to have. First of all, you need to look at everything that's coming in and going out. So, for example, there is the income inflows. So this couple, this sample couple is making this much in income. Then their expenses. The expenses include all their living expenses, their travel expenses, groceries, mortgage, child care, etc. Tax payments, how much they're planning to save in 401k or other vehicles, and then their total outflows. And the inflows minus outflows gives you what's left after they spend everything they have to spend. So doing this from now until the rest of your life gives you a picture of how much you actually need to have in terms of your cash flows in order to be able to comfortably live the quality of life that you want to. And there are, so besides doing this, we also want to make sure that you're taking inflation into account, right? Because whenever you look at money from a very long-term perspective, inflation always makes a huge difference. Because whatever things cost today is not what it's going to cost 10 years from now. The long-term inflation rate for the United States is 2 to 3%. That's how much the prices are increasing every year. In the last few years, it's been increasing a lot more than that. But there are certain things that are increasing at a higher rate than 2 to 3%. One example is education. The cost of college is actually increasing at about 5 to 6% every year. So you want to make sure that that the goals that you have projected for yourself in the cash flow are adjusted for inflation. Speaking of goals, this client has two goals. So one is that their kids, they have two kids. They're going to college in 2033. Their first child goes to college, and this is how much it's going to cost them. In 2035, their second child goes to college. This is how much this is going to cost. So when you do your cash flows, you have to make sure that you also put in your goals in here to figure out if you have sufficient money or not to cover those goals. And if you don't have sufficient, then you need to figure out how you save and invest enough to be able to hit those milestones. Now, the reason why I like doing the cash flow is because it shows three things. First of all, is figuring out, will you be able to meet your goals? As I mentioned, this with the college goals, for example, are we in a good shape to meet those goals? Another goal this sample client has is to retire at age 67. So at age 67, their income goes down dramatically from almost $1 million to only about $100,000. And at that point, they are going to not be able to rely on their income, but they have to take money out of their assets to be able to spend money, right? So we want to make sure that you are prepared for those goals. The second thing it shows is, are you going to be okay from now until end of life financially? So once this client retires, their income goes down dramatically, and at that point, they're just spending from assets. And will you have enough in assets to be able to do that, to be able to spend from your assets or not? So that's the second thing this shows. The third thing the statement of cash flows shows is kind of a what-if analysis, right? One of my favorites, what-if analysis that comes up often is how much of a house should you buy? How much of a house you can afford. So living in the Bay Area, we know that our house prices are so expensive, right? And then even more expensive than the house prices are property taxes. So whenever you're thinking of buying a house, you need to take into account all of those things, the mortgage as well as property taxes. And this basically shows us, are we going to be able to afford, the house that we might have an eye on? So that's the first thing. The second is also, a lot of times, you might have a large stock position. You might get stock from your company, or you might get equity compensation in the form of stock options or ESPP plans from your companies. And oftentimes, I see that people are so attached to those concentrated positions. They're banking on the stock prices going up, but stock prices don't always go up. They might go down, or they might just stay where they are. So this is also a way for us to see what is the minimum amount we need from that concentrated stock position, from either the company stock or from the equity compensation, to be able to hit all the life milestones you might have, so that you are not so you're not short, you're not short on cash, basically, should the price of the stock go down. And the way we do that is by doing something called a gap analysis. So we look at the cash flows, and do a full financial plan without taking into account a stock compensation or a concentrated company stock portfolio a client might have, and see what the shortfall is. And then that is the shortfall amount that we have to protect in those concentrated stock position, to be able for the client to be able to live the way they want to. So that's another what if analysis we can do using the statement of cash flows. So you can very easily do a statement of cash flows for yourself just by using a spreadsheet. You can look at your just the same things, the same components here: the age, income, your expenses. You can use any kind of budgeting software to be able to see all of your expenses, like Monarch Money, or even You Need a Budget. That's another app you can use. Or you can just do it manually by pulling your bank statements, your credit card statements, and looking at your monthly expenses and seeing how much you're spending. So that can be your expense line, tax payment. You'll know that from your tax returns. And then that will show you how much money you actually are spending, and versus how much you're making. And you could do a projection of the same thing from now until you're 90 years old. But always be sure to take inflation into account. So you can just increase your expenses by 3% every year to see how the expenses increase versus your inflows. And that'll give you a good idea of how much cash flow you need, basically. Now, of course, when I'm helping a client do this, it has to be the financial plan has to be more accurate than just spreadsheets. So I actually use a financial planning software for this, which helps us project out the inflation and the tax payments pretty accurately. But you can do it but even doing this with a spreadsheet will give you, some starting idea of, are you in the right track or not, or if you need to make some big changes in your cash flows. Okay, so that's the first thing that we have to do to get clear on your finances. You also want to do some kind of a stress test to see if your cash flows are viable or not, right? So the way we do it is by doing something called a Monte Carlo analysis, which is kind of a statistical trial. It puts the financial plan through 1,000 different scenarios. Some of it have happened, some of it have not even taken place, like a war and a recession at the same time, or a depression. So it just kind of looks at our plan and shows us, is our plan going to be sustainable should these external factors take place? And for this sample client, their probability of success, which means that they never run out of money, success is not running out of money, is 35%, which means that there is a 65% chance of them running out of money despite having such a healthy income. Because we always underestimate how much we actually need. Because human life is so, it's so, how do I say this? It's so susceptible, right, to time. We have a certain number of years where we're earning an income, and then at some point we all have to retire. We all have to stop working, and at that point our expenses also go up through the roof. In healthcare, in other things, it goes up a lot. So even though we might think that we're making a great income today, everything is fine, we're living a good life, at some point we have to understand that we have to start spending from that asset, and we have to be prepared for that, right? So this is what shows us, are we prepared for that point where we have to spend money from our assets or not? And this shows that this sample client is not prepared, because there is a big chance of them running out of money at some point in their life. But if they do some of the changes that they needed to make in the financial plan, then their probability of success goes up to 90%, which means that they never run out of money. So you can do a stress test yourself as well. And some of the things you can do is you can increase that 2 to 3% inflation to 10% to see what would happen to your cash flows should inflation go up, should your expenses go up by 10% every year or at certain periods. You could also look at your investments and assets and see, what if there is 30% losses for 2 to 3 years? What is that going to do to your assets? Are you going to be able to keep up? Are you going to be able to spend from that asset base to be able to support you in retirement? So doing that kind of stress test will give you some idea of, are you sound, are you financially sound or not? Okay. So the next reason to achieve financial independence, as we talked about before, is career flexibility, to be able to achieve early retirement, a sabbatical, or to start your own business. Now, to do that, you have to be able to invest. Investing is how you turn your income into long-term assets. There is just no two ways about it. You have to be able to invest your money in order to actually create long-term wealth. So some common reasons for not investing, why people put off investing, is the number one reason is fear of losing money. How many people here invest their money? By show of hands. Okay, it's a good amount of you. Great. That's good. Yeah, so the first is fear of losing money, because we hear so much in the news about how the market had a bad day and there's a recession looming, right? So there's always a lot of fear about bad things happening. And a lot of people who are fearful of losing money, they think of the stock market as a lottery, as some kind of a like playing, like gambling in Vegas, right? But the stock market is not gambling. It's not dumb luck. You're not investing you're not just putting money and then hoping everything works out, right? You are investing in companies that are creating value, right? Like when you invest in Apple, you're investing in a company that is innovating, that is producing products that's changing people's lives. Or when you invest in NVIDIA, or when you invest in any tech stocks, or even other, more consumer-oriented, more value stocks as well, they're all doing things to change people's lives, and they're making products to enhance our economy. So it's not dumb luck. It's not just, putting your money in something and hoping things go well, but you're actually investing in something that is creating value for the world. So investing is very different than just, playing lottery. So the fear of losing money is really unfounded, because by not investing, you're actually guaranteed to lose money in the form of inflation, right? So this is just an example that shows how much money we lose with inflation. So if you had $100,000 sitting in your mattress, right, sitting under your mattress, I should say, for the last 30 years, from 1994 to 2024, the last 30 years, if you had $100,000 sitting in a mattress, that $100,000, whatever the $100,000 was able to buy in 1994, only buys about $47,500 worth of stuff today. So you've lost 52.5% of value of that money by not investing in the last 30 years. And it looks so dramatic because we're looking at last 30 years. But even if we look at the last couple of years, the market has gone up so much that if you didn't invest for the last couple of years, you will still be losing a lot of money. And if you increase that even to 10 years, it's a lot more, right? So by not investing, you're really losing money. The money is not safe. Similarly, if you had just invested in 30-day T-bills, treasury bills, which are just short-term government bonds, basically, you would still be losing money. It would only buy you $93,800 worth of stuff. If you invested in U.S. bonds, which is a little better than the 30-day T-bills, you would be a little bit up, but in 30 years, it would just give you $155,000. But if you had invested in U.S. stocks, that $100,000 would be worth almost $1 million today, right? So the power of investing, the power of compounding is huge. The second reason why people hesitate investing is they are saving for a large purchase in the future that never happens. This is something I see all the time, right? Like people think that they are going to buy a house and they're saving for a house, but then it becomes too expensive to buy a house, or the Fed increases interest rates if they don't buy a house, and the money just sits there, 100,000, 200,000, almost $1 million. It's just sitting in cash year over year, earning nothing. So that's also, not a good reason not to invest. Something else is oversaving for emergencies. So there is this feeling of how much money we should save for emergencies, and people just want to feel comfortable, and they want to just have, a big cushion, a big cash cushion, and they feel safe seeing that money in their bank account every day. And that is, that's not a good reason either, because you don't need to oversave for emergencies. You only need to save enough for emergencies. You only need to save enough for non-discretionary items during an emergency. Now, what that means is if an emergency might be getting laid off from work, right? If you get laid off from work, if it takes you 2 months to find another job, that's your emergency time period, right? If it takes you a month, you only need to save for a month. If it takes you 2 weeks, you only need to save for 2 weeks. And even during that time, you don't need to save for every expense, right? Because when there is an emergency, we tend to tighten our belt. We don't take extravagant vacations. We don't buy extravagant things, right? So we just focus on the essentials like mortgage, groceries, childcare, tuition for kids. Only those things we need to save for. So oversaving for emergencies is another reason. And then not knowing where to start in indecision, right? So this is where having an advisor or somebody to help you can be a great can be great. And sometimes people, they don't tend to find an advisor, and they just kind of let the money sit there, and the months turn to years, and it just, sits like that. So not knowing where to start is also another reason. So how to get started with investing? So the first thing to do is to understand your goals. Okay, so understand your goals, and what that means is knowing how much you need and when, and also taking inflation into account. We'll look at it in the next slide. The next thing is to find an investment mix that helps you achieve your goal as well as gives you peace of mind. So once you know how much to invest or once you know how much you will need in the future and when, your time horizon, then you're able to understand what kind of investment mix do you need. Do you need to be 100% in stock? Do you need to be a little bit in bonds? All of that will be clear to you after that. Right? And then invest in a tax advantage way and diversify your tax base. There is often a tendency for people to just put everything in 401k only. Well, just investing in 401k is great, but if your goal is also to retire early, your 401k assets are locked until you're 59 and a half, right? If you start pulling money out of your 401k before you're 59 and a half, you'll end up paying taxes and also a penalty. Right? So you don't want to just oversave in one tax-based vehicle only. You want to diversify it. That's really important. So let's look at an example of how you can devise your own investment strategy. So this is a 529 plan. It's a college fund that is a great way to save for your children's education. Should you have kids. When is the best time to fund your 529 plan? It's as soon as the child is born, so that you have a lot of room for the money to grow. You have 18 years for the money to grow, right? So how much should you put in your 529 plan? You want to fund 33% of the child's education cost using the 529 plan. Now, why 33%? Because the 529 plan is basically the goal is that the money in the 529 plan should be used for educational purposes only. If you use it for other purposes besides education purposes, there is a penalty, and you also end up paying taxes. So to avoid that, you don't want to overfund the 529 plan. And when a child is born, you don't know what their aptitude will be like. You don't know what kind of college they want to go to. You don't know if they're going to get a scholarship. What the world will be like when they're 18 years old. So you don't want to overfund the 529 plan. So staying at about 33% is a good idea. That's a third of whatever the college cost is. So what you do is you first figure out what kind of a college the child might want to go to. If it's UC Berkeley, what does UC Berkeley cost today, right? To figure that out. And then you take inflation into account. So if you just do 6% inflation for the next 18 years, what is that going to look like? So it's probably going to look like this, So So the cost of education for the child is going to be $431,912 for a 4-year college in year 2035. So if you fund 33% of that, if your goal is to fund 33% of that college cost using the 529 plan, that'll give you some idea of what kind of investment mix you need. And the investment mix that we decided for the sample client was an 80% stock, 20% bond allocation, which would give them enough growth, but also at the same time control the risk on the downside as well, so that the money would be there when the child is 18 years old. That's one way to devise an asset allocation investment strategy for your goals. Okay. All right. The next thing to be able to have career flexibility is also do good strategic tax planning. And tax planning is different for everyone. So for most people, all of these strategies are available. You have the 529 college savings plan. If you have kids, you have HSA, which is a healthcare savings account. These are highly tax advantaged. They're triple tax advantaged. You don't pay any taxes when you put money in. The money grows tax free. You also don't pay taxes when you take the money out. So they're highly advantaged. Charitable gifting strategies. This is things like donor advised fund that you can use to give you lots of flexibility when it comes to giving charitably. Roth conversions. This is where you can convert your traditional 401k or traditional IRA into a Roth. You pay tax, but then the money grows tax free. So you have to do an analysis to see, is it worth it or not? And that's something that you'll have to look at, like how much tax you're paying versus how much it'll grow. What is the timeline of that growth? So when you do that, it's a great strategy to do. Strategic distribution in retirement. So this is basically looking at which bucket to take money out of when you're retired. And then 401k and Roth 401k. So a lot of people have an option to invest, to put money in both a Roth 401k or a 401k. And the rule of thumb there is that if you're younger in your career, it's best to maximize your Roth 401k because the money will grow tax-free over long periods. But if you're more mature in your career and if you're kind of at the peak of your earning years, then it's better to contribute to a 401k because this will lower your taxes as well. If you're a tech professional, you want to maximize your equity compensation. These are the various types of equity compensation that's available to tech professionals, like incentive stock options, non-qualified stock options, RSU, ESPP plan. So there are different tax implications to each. So you have to look at kind of, not just taxes, but also the risk and reward of each, right? So the gap analysis that I mentioned to you before, that looks at how much risk we should be taking in your equity compensation. And once you have that, then also project out the tax implications of exercising and selling the stock. And that you will know by looking at your tax returns and doing a tax projection of how much of what the implication is of exercising the stock and selling the stock. If you are a self-employed or a business owner, you have access to a SEP IRA or a solo 401k. So between a SEP IRA and a solo 401k is a lot more advantaged than a SEP IRA is. Than a SEP IRA is because you have access to, because you can put away a lot more in a solo 401k than a SEP IRA. In a SEP IRA, you can put much less. In a solo 401k in 2024, you can put all the way to $69,000. So there's a lot of different things you can do depending on what your status is. Okay. So the last one is to have less stress. And to do that, you have to focus on two things, which is insurance and have an estate planning. For insurance, you need life insurance if you have dependents, disability if you're working, and long-term care. So life insurance, pretty self-explanatory. It's basically, having insurance should something happen to you. Your dependents, your beneficiaries will get a payout. And how much life insurance do you need? A rule of thumb is to have 10 times your income, your annual income. So if you make $100,000, you want to have $1 million in life insurance. Okay. Disability, this is basically if you are working, then your disability insurance gives you a payout should something happen to you. And disability doesn't mean total disability. It can also mean you cannot work 40 hours because of a backache or something. So very important to have disability insurance, and the rule of thumb there is to have 60 to 70% of your income covered with the disability insurance. Long-term care, this is end-of-life care like nursing home facilities or a nurse coming to your home, etc. This is really, really important to get. The best time to get it is when you're in your late 40s or early 50s. The reason is because it's very expensive to get long-term care, but it's very important to get it because almost all of us will need it at some point. It's the most used insurance. A lot of people never use life insurance. It just expires, before a person passes away. Long-term care, most people will use it. So very important to get it, but it's also very expensive. So for that reason, you don't want to get it too early because you'll end up paying a lot of money, but you want to get it at the right time, which is late 40s or early 50s, because if you wait too long, you might not even qualify for it, right? Because we start getting, as we age, we start getting other ailments, and when there are too many ailments, insurance companies will not cover the person. So long-term care, very important. If you have rental properties, if you have a business, if you have a lot of money, if you're high net worth, definitely get excess liability or umbrella insurance. This covers you against anything that is beyond your main insurance. Like if you hit somebody with your car and they realize that you have a lot of money, they might come after you for more than what the auto insurance covers, and that's where an excess liability insurance protects you. Buy-sell agreements if you have a business and if you have business partners, very important. The last thing that you need is to protect your assets and save taxes with estate planning. Now, estate planning is a very complicated and a very large bucket, and it really depends on, what your status is, how big your estate is, right? What is an estate? An estate is what you leave behind once you pass away. So for some, it might be just a house and a few bank accounts. For some, it might be a business or a lot of money and a lot of assets, right? So depending on where you are, it's going to be very different for each person. The basic estate planning is important for everyone. What is basic estate planning? A trust and a will, financial power of attorney, and a healthcare power of attorney. A trust and a will basically dictates what happens to your assets once you pass away. It's all your wishes in a trust. A will is also similar, but a trust is more robust than a will because a trust it bypasses the courts completely. The court's not even involved in the trust at all. A will still needs to go through the court system because it needs to be ratified by the court. A financial power of attorney basically allows somebody to take action on your or basically allows somebody to access your accounts should something happen to you, right? So if you're incapacitated and your spouse needs money in order to do your treatment, they will not be able to have access to your accounts unless they have financial power of attorney. So very important to have this figured out. Healthcare power of attorney, this basically gives access to someone to take end of life decisions on your behalf. And those decisions, you will have already put for yourself in the healthcare power of attorney with your advanced healthcare directive, saying this is how you want to be treated. Should you, be on life support, or what kind of treatments you want to get. So this is the foundational estate planning that most of us will need. And then this is, if you have a business, a family business, a succession plan is something that'll be important to you. If you're a high net worth individual, especially if you have, so right now there is an estate tax exemption due to the Tax Cuts and Jobs Act of up to $13.6 million, which means that if you have less than $13.6 million to give to somebody, including your kids, you won't pay any estate taxes on it. But if you're giving your kids or anybody else more than $13.6 million, you pay an estate tax on that gift. So as long as you have less money than that, you don't need to worry about the irrevocable trust planning. But if you have more, then irrevocable trust planning becomes important. However, this Trump tax cut is going to be sunsetting in end of 2025, where this exemption goes back to about $7 million. So if you have $7 million or more to give to your kids or in your estate, so it's $7 million per person. So it's $14 million as a couple. If you have more than $14 million to give to your kids or somebody else, then irrevocable trust planning becomes important, where you want to reduce your estate taxes when you pass away. And lastly, this is if you want to partner with an advisor, these are the top 10 questions to ask, of which question 3 and 7 are the most important. Question 3 is, are you a fiduciary? Will you have a fiduciary duty to me? Every person that manages your money has some fiduciary duty, but you want to go with somebody who is 100% fiduciary, also known as a fee-only fiduciary advisor. And the reason why it's important is that a fiduciary, a fee-only fiduciary has a higher level of standard of care when it comes to client service, whereas a broker-dealer has a lower standard. So if there are two products, they do the exact same thing, but one is more expensive than the other, a broker-dealer can actually recommend the more expensive product because it might give them higher fees. But a fee-only financial advisor, a fiduciary advisor, has to recommend the product that does the job with lower cost, okay, because they have to act in your best interest. So you always want to find a fiduciary advisor who is a fee-only advisor when it comes to looking for an advisor. Number 7, do others stand to gain from the financial advice you give me? This is talking about commissions. And this is also very important because many a times when you go to a financial advisor, they might try to sell you insurance that you may need or may not need. So, and the reason for that often is because there is a commission that a lot of advisors might make from a third party, like an insurance company. And although you might never see it, it will affect their recommendation because they have an incentive now to recommend insurance that you don't even need, which costs a lot of money, right? Annuities that cost a lot of money. So you always want to avoid advisors who make any commissions. So a fee-only fiduciary advisor makes no commissions at all, and that's really important to find an advisor who does not do any commission-based business at all, because there the incentives are really misaligned, which you don't want. So that brings us to the end. This is how you get financial independence, all the steps here. And the last thing I will say is, so I'm offering a complimentary 20-minute consultation to all of you here. If you email me at roshni@truwoodfinancial.com with the subject line consultation, I can schedule some time with you. If you would like to get the presentation and also other resources that I have, just email me here again and just with the subject line, send me the stuff and I will send that to you. And this is my website.
Well, one more round of applause for Coach Johnson.
You guys.